Let's give you a sense of the latest in the world of business, starting with a market update. The JSE is little change so far today, while its global peers are mixed as investors consider the implications of a strong U.S. jobs report on the monetary policy outlook. Portfolio manager at Rand Swiss Gary Booysen joins us now for an overview of the latest market developments. Gary, a very good afternoon to you. Thank you for your time. The Rand is suddenly sluggish against the U.S. dollar. What is driving sentiment in that space?
No, I think you mentioned it. It was that very, very strong non-farm payrolls report that we had out on Friday. So it wasn't just the actual number, which was 353,000 new jobs added for January, but it was a huge revision to the December number as well, which just shows that the U.S. labor market is still very, very strong. So anyone that was hoping for interest rate cuts in March out of the Fed, I think any hope of that has been dashed. So if I look at the underlying pricing, there's about 86% chance, according to the markets, that there'll be no change at the March meeting. There's about a 60% chance we will still see a rate cut in May. And if you look all the way out to June, there's a 93% chance that we'll get the first of the Fed rate cuts by June. That's according to market pricing. Powell's also said, he's looking at around 3 rate cuts for this year. But, with interest rates seeming to be a little bit higher for longer in the U.S., that's just helped to buoy the dollar. And that's why you've got the Rand-dollar exchange rate out at 18.95 currently. And yeah, a lot stronger. And unfortunately, South Africa will follow the U.S. So maybe any hopes of an early rate cut from the South African Reserve Bank also looking a little bit more bleak today. Yeah.
The S&P Global South Africa Purchasing Managers Index inched up to 49.2 in January from 49.0 in December. What does this data tell us about the state of the sector and the overall economy?
Yes, so remember the PMI numbers, a reading below 50 indicates contraction. So 42.9 is the second month that we've seen this in contraction, and it's a slight decline in private sector performance. It is a very volatile number, though. So we have seen it kind of grow and contract, over the last year. It's been very, very choppy as PMI numbers go. But part of it is less new orders from the international community, based on I think a weakening global demand. At the same time, we have, the shipping disruption that we're seeing through the Durban ports is also crucially impacting this number as well. So, we need to be able to import and export to have this number improve.
Itel Tile released the latest voluntary trading statement for the 6 months, which ended in December, the 31st of December 2023. Help us make sense of that performance.
So it's a decline. So it wasn't a hugely detailed trading statement. The stock is down just over 3% on the back of this voluntary trading update, but I wouldn't read too much into that because there's only been 1,600 shares traded. So it's quite an illiquid counter at the moment. So I wouldn't look at it as necessarily negative, although we are expecting an earnings per share decrease of between 13 and 17%, both on the EPS level and the HEPS level. We're going to find out more information, obviously, on the 19th of February when they release their results. But I think it's to be expected. And as I said, I wouldn't read too much into that share price movement because the kind of high base that was built over the COVID period is slowly unwinding. We understand that the retail market in South Africa is still very, very tough. People not spending on home renovations at this stage, I think just happy to be able to service their bond payments until we get some of those rate cuts. So it did look negative as in the profitability is down, but the company has been warning about this for some time. So I don't think that the market is too shaken by the number, and it really just remains to be seen. Let's get the rest of the data out on the 19th.
Yeah, absolutely. Samsung Electronics chair J.Y. Lee was found not guilty of accounting fraud and stock manipulation. What do those developments tell us?
Oh, Samsung's a very, I suppose the South Korean market is a very, very complex place. There's a lot of politicking. There's a lot of, almost backdoor deals that get done. And I think this is optimistic for the company. So reading kind of analyst reports, they say that this kind of decision does, pave the way for, I think, a smoother functioning at Samsung just because there'll be less bureaucracy. It does seem like over the last couple of years, the company has almost, lacked innovation and lacked the ability to change because they've had these legal problems hanging over them at least. So remember, this is essentially based on court battle from 2015. So it really has been with the company for almost 9 years, and I think those legal risks have been elevated. So nice to see that coming out. But as I said, the South Korean environment is very, very tricky. So you've got to remember Lee was jailed previously in 2017 for bribing a friend. He then got a presidential pardon. So a lot of politics happening in the background. But I think overall, having those legal risks removed, probably pretty good for the company.
Very well. Thank you so much for that input. Portfolio manager at Rand Swiss Gary Booysen, giving us a sense of the latest in the world of big business and what the markets are looking like this afternoon.